My name is Bill Merrill, and I'll be moderating today's discussion through several great speakers that we have today. We will go to Brian Zitin and then Ken Diggs. So Brian, I'm going to turn it over to you.
Awesome. Thank you very much. So hi, everyone. My name is Brian Zitin. I'm the CEO of a company called Reggora. We are a fintech out of Boston where we provide software that streamlines the appraisal process. Our platform facilitates the ordering and completion of hundreds of thousands of appraisals for more than 100 different financial institutions across the country. And so the workflows of appraisals and valuations are very near and dear to our heart. So I want to thank the FHFA for allowing myself and other key stakeholders in our industry today to provide input on the challenges that we all face together. And the main points that I want to focus on today are around the FHFA's request for input on both appraisal waivers as well as alternative valuation products. And so, while it is our belief that the main priority of the appraisal is to instill confidence and trust in a piece of collateral's value, both for the consumer as well as financial institutions, it is undeniable that in 2021, the current processes in place to ensure this trust have caused a supply side issue where we do not have enough appraisers to meet the demand. This can clearly be seen by the significant increase in appraisal turn times that are occurring in the market, despite an increased number of appraisal waivers. This shortage of supply creates serious potential for liquidity problems in the mortgage market as appraisals potentially delay transactions. And as the number of active appraisers continues to decline year over year, this problem will only worsen, creating systemic risk due to the responses from market participants trying to meet the demand by doing things such as increasing the number of appraisal waivers or gaming of these automated underwriting systems. Therefore, it is of our opinion that these new processes must be designed, which most importantly reduce risk and ensure confidence in collateral value, but also balance the need for liquidity in the mortgage market. So we believe that appraisal waivers on low risk loans most definitely have a place as part of this, as they offer significant cost benefit to the consumer, as well as relief in meeting demand as part of the previously mentioned liquidity burden. That being said, appraisal waivers also create systemic risk because the same automated underwriting models making the decisions on which loans are eligible also utilize inputs such as property data and insight gathered from trusted sources like appraisers. And so, as the number of waivers increase over time, the number of property data inputs feeding these actual models, which are making these decisions, decreases over time. The consequences of this is that the accuracy of these models will erode unless enough sufficient quality data input is received. Because of the recency of appraisal waivers and the long time horizon of foreclosures relating to them, long-term systemic consequences of impaired underwriting model performance are unknown. The most recent increased level of appraisal waivers is even more unprecedented. And so it is our belief that the current level is most likely too high, given that we don't understand the full statistical picture yet. Since the main risk with appraisal waivers as it relates to accuracy of value is the inability to validate the current condition and any changes impacting the property, introducing an intermediary product that maintains the appropriate level of risk while balancing turn time and liquidity concerns is crucial. So the key to achieving this balance will be two things. One, enlisting a potential workforce, which can actually increase the supply of people fulfilling these inspections. And then number two, ensuring these inspections maintain a proper level of data quality. The good news is that because of the accessibility of smartphones, as well as recent improvements in new technologies such as computer vision, geolocation tracking, LiDAR, and much more, there's been a significantly lowered bar in terms of the level of expertise required to ensure proper data quality. If the industry can come together to design a standard around what an inspection must entail and the level of data quality required to ensure proper risk management, then theoretically any type of workforce which can visibly demonstrate meeting these standards should be able to fulfill these inspections. This can be accomplished in the same way that we have people pass a standard course and test for a driver's license. If we as a society can establish risk comfortability around people operating 1,000-pound steel machinery moving at 60 miles an hour, surely we can design a process which ensures the underwriting standards of a property inspection and be comfortable with it from a risk standpoint. So to summarize, we need to balance both risk management and liquidity in order to create a stable and sustainable lending environment. Although waivers have their place, the current level is most likely too high to be systemically safe. And so in order to reduce risk while maintaining proper liquidity and cost, it is encouraged that alternative valuation products replace some percentage of waivers as long as they can confirm the property condition and changes while utilizing a more accessible workforce. If we can create a North Star around what the standards of these inspections need to be in order to ensure proper risk management and implement this in practice, it will be a huge win for the consumer, the lender, and valuation professionals alike. Thank you very much.
Thank you, Brian. Really appreciate your comments. So next we will go to Ken Dix.
Thanks,
Ken.
Bill. Thanks, Bill. Appreciate it. My name's Ken Dix. I work with Brian over at Reggora. I'm the Director of Appraisal Compliance and Initiatives. My background is about 35 years of appraisal experience in the valuation industry for both residential and commercial. I've served in roles as an independent appraiser, bank appraiser and reviewer, tax assessor, and a collateral risk program manager for a large regional bank before joining Reggora this year. I wanted to echo Brian's appreciation for being given the opportunity to present today. And to further hone in on the key aspects that will be important as we consider the practical implication changes to and improve appraisal processes going forward. The level of expertise and experience assembled for this event shows the commitment by key stakeholders to bring forth positive solutions that will instill confidence in the marketplace. At a high level, balancing proper risk management across the entire spectrum of property types, geographies, and loan products will require an approach which segments risk appropriately. Consideration of key available inputs include credit risk, property-specific risk, market risk, data integrity risk, and more. Appraisal waivers and the use of AVMs have been risk management tools utilized by the industry for years. Because of risk, AVMs are required to be fit for purpose. There's inherent risk by using AVMs because it relies on key assumptions relative to the condition and the external influences on a property. Experience has shown that failure occurs when widespread use of AVMs are coupled with a willingness to not discover what is discoverable and to test the outcome of blind assumptions. We are all too familiar with the outcome of widespread AVM use with HELOC lenders during the Great Recession. In 2020, more than 3 million mortgage transactions were completed using waivers, many having an AVM inserted as part of that process and that decision. Assurances are needed to ensure that those transactions that benefited from AVM usage are not adversely impacted by the actual conditions contrary to what those assumed conditions are. Intermediary valuation products such as hybrids that are in use today by lenders are able to mitigate some of the risk. However, these products, they lack uniformity and have limited applicability in the mortgage marketplace. As we all know, appraisals and the development of appraisal-related opinions of value are a process. There are opportunities before us to expand valuation service products to allow for flexibility of primary data collection by either the appraiser, supervised by an appraiser, or incorporated by the appraiser in their valuation product. These are all measurements of collateral risk. USPAP allows this, and the recent past over the past 12 months with COVID has shown that we can be flexible when it comes to data collection, provided that there's a lot of forethought in this and that it's risk appropriate for the transaction. Now, there are tools that are readily available. We've seen some of those tools today. Scott Rose had a great presentation. Tools are readily available to be inserted into risk assessment processes. The reporting of the data will need to be standardized and universally applied for enterprise acceptance. Development of additional and supplemental products and sharing of primary data of property by the enterprises is strongly encouraged to ensure that we have data integrity in the marketplace. We encourage any efforts to allow for expansion of valuation service products to remain within the existing regulatory framework that has served this industry for over 30 years, and to incorporate similar frameworks if we are using outside sources for data collection. Like the prior speaker spoke before, there's a public trust here that has to be maintained. We have a proven track record. USPAP works, licensing works. So that system cannot be circumvented by what we're doing here today. Elimination of gaming of opportunities of waiver decisions can be mitigated by requiring collateral validations by either by process or development of new products, as a basis to test model assumptions. I'd like to wrap up my comments by bringing to light a use case on waivers. In the late summer last year, an appraisal waiver was granted on a house in Massachusetts as part of a low-risk refinance transaction. In hindsight, through validation of the data with that, the enterprise made a favorable decision off of a 6-year-old appraisal and a model measurement of the current value. The homeowner had the good fortune and security to be able to expend the funds to update the kitchen, replace the roof, replace the furnace, since purchasing that property 6 years ago. The enterprise risk position was benefited by the mortgagor's ability to do those things. That poses a question. What if those circumstances were different and there were no updates to that property? There were no updates to the kitchen, the roof failed, or the furnace failed. How would the enterprises account for those unknown adverse conditions from those failures, and what impact would that have on the risk position? Together, let's bring forward innovative initiatives and thinking on how to advance reliable and consistent measurements of collateral risk, taking on the perpetuation of bias head on, building off of and fortifying the talent and the strengths of the processes that we have today. Thank you very much.
Thank you to you all. It's an immense investment of time to be here with us, and we greatly appreciate it.